Hi. In our discussion in insurance benefits, we looked at level amount, that the level amount of benefit is 1 unit, and if we want $1,000, then we multiply it by 1,000, but it's one level, 1 unit, a level amount. So now what we will look at whether the benefit maybe it's increasing or decreasing at variable benefit level. We'll start with the continuous case, and later on we will look at the discrete case and try to relate them to each other. So let's start with the continuous case. In the continuous case here, we will have new notations, but the notations, they make logic. They should make logic. So let's start with this new notation here. We have this one. It's I, A, so I for increasing, A for insurance benefit, and for somebody age X. So increasing benefit for someone's at age X. And we will start with this case, a bar over A. So we know that whenever A has a bar, it means that the amount of benefit pays at the moment of death, but it's I for increasing. So this one, what we would wanted to say here is it pays at, like if you have this line, this is X, X plus 1, X plus 2, X plus 3. So if we want to see what it pays, it will pay 1 here if death occurs here. If death occurs here, it will pay 1. If death occurs here, it will pay 2. If death occurs here, it will pay 3. So 1, 2, 3, 4, 5, 6. So it pays like this, just to remember, it pays $1, and because there is a bar here, it's at time, sorry, like I should have written it not at the end, but rather 1 here, 2 here, 3 here, because there is a bar on top of the A. Then if death, okay, at moment of death, it pays $1 at moment of death, if death occurs at first year. Right? And it will pay this same one, it will pay now not $1 but $2, right? At moment of death, if death occurs second year, right? And then it will pay also now $3 and third year, right? And this is what we mean by AX. So it's again X for age. The bar here, it tells us that the benefit is paid at moment of death. I is for increasing, right? I is for increasing. And but now let's look at another one now. Let's look at another case here. What if we have AI for X n? Let's give this one and one here. It's straightforward, right? It pays $1 at moment of death. If it's bounded between, it will pay $1 at moment of, 1, 2. So if death occurs here, it pays 1. If death occurs here, pays 2, right? And if death occurs, let's say n minus 1, between n minus 1 and n, then the amount will be here n, right? And this we need to be careful about it. Like there is a logic for this one. So this one will be at the moment of death, right? So, but it's bounded. The same thing as the first one. There is nothing different, but it's bounded. 1, 2, 3, 4, 5, 6. So now let's look at another one. Now IA X, and I want you to see now there is one here and one here. Now it's getting harder. There are two bars. We know that when A is continuous, or the benefit is continuous, then it pays at moment of death. That's clear. But what I is also continuous. This is what it tells us. It pays T. Let's say T is year of death. It pays the amount at year of death, T, at moment of death. T at moment of death. Right, it pays T at moment of death. So this one will look like this. So let's say death occurs here. What is T? Maybe, you know, death occurs in 2 years, 0.7. So the amount will be 2.7. Right? So it's simple. You need to really be careful about this. Again, the bar over A, it tells us that it's the benefit amount is paid at the moment of death. There is no bar. Then it tells us the I, the increasing, is not a continuous increase, but rather 1, 2, 3, 4 discrete increase. Now this one, A is paying us at moment of death. The I here, because it's bar on it, it's continuous, so it pays exactly the amount of time. Like if it's in 3.7 years, then it will pay 3.7. How we evaluate this one? Let's look at the general form. For continuous case, remember we need to integrate in continuous case. General form to evaluate this benefit. It's the general form, and then we'll take example. The general form for the expected value of Z, any of those benefit, we need to look at from, you know, like we look at it from 0, it can be to infinity, but if it's stamped n until n, so what we will have is the benefit amount. The benefit amount, again, it can be 1, 2, 3, 4, 5, 6, or it can be not increasing by 1, but it can be T also. If it's for this case, we'll replace it with T. Benefit amount, we need to discount it, E delta T, and we need to multiply it by the probability, remember, which is f of t dt. Can write it also 0 to infinity dt e minus lambda t, and then tpx mu x plus t dt, right? So this is the general form, right? So it's, again, if we have the benefit 1, 2, 3, then we need to do the benefit, change it with 1, 2, 3. If the benefit is continuous T, we will replace it with T. But let's take one example here and see how we can evaluate function like this. Let's take one example. Let's simplify it, you know, take the easiest form to handle, because this is very hard to, you know, like to deal with the complex form. So let's say that the remaining lifetime random variable is uniform, and you know, uniform is easy. Let's make it very small, between 0 and only 2 years, just it helps us to understand. Delta is 5%. So let's try first to find IA of x. Remember here, it's the, if you want to visualize it, here you have 0, 1, 2. The good thing it's that the life, it's uniform over 0 to 2. So that's easy for us. So it will pay if death happens here, 1. If death happens here, it will pay 2. It's not continuous, the payment, so it's either 1, 2. So now we can compute this one easily by integrating. Let's use the general form here. the general form here. So bt here, it's, well, we need to split it first from 0 to 1. From 0 to 1, it's 1. Then we need to discount it back. Interest, force of interest 0.5%. T. Then we need to multiply by, remember the general form, we need to multiply f of t or tpx mu xt. Because this is uniform, if you remember that ft for uniform is 1 over omega minus 0, which is 1 over 2. Right? So multiply it by 1/2. Where the 1/2 we get, it's the f of t. dt. This is one term, plus the second term is 1 to 2. Now the benefit amount here is 2, the green one. Oh, sorry, here minus. E minus 0.5 t, this is delta, multiply by 1/2 dt. Now this is easy, right? This is very easy once you know this one. And you see that we have 1, 2 because the I is not continuous. So now let's compute this relationship here. It's easy, right? So if you compute this one, we take the antiderivative of this one is 1 over 0.05 minus, right? E minus 0.5. Oh, there is 1/2 here. So let's replace this one with minus 0.10. And this one from 0 to 1 plus. Now the 2, they cancel out, so here 1 over minus 0.5 e minus 0.5 t. From here we have from 1 to 2. Now if you use your calculator quickly, I mean, you can simplify this 1 over 10, it will be 10, so it will be 10, and then because there is minus, because we plug in 0, it will be 1e minus, there is t here, sorry, do you multiply this by 1, right, and this is, then this one, 1 over this one, it will be 20. Same thing. Now if you switch it, then you take the 1, it will be e minus 0.5. Now the 1 you started first because negative, I flipped it, and e minus 0.1. If you do the math here, it will be 1.4155. I did it before, so right. So it will cause this special increasing benefit 1.415, right? And it's always good to visualize it because once you visualize it, helps you to understand it, right? Now let's take another case here. Let's find now I, A, X. Now this one is continuous, so like the one before, it's continuous, or payment is made at time of death, and the I is continuous. So it's not 1, 2, 3, it's not step, it's T, it's continuous. So this, we use the general form here, right? So it pays T at time of death because T is increasing, you know, time is increasing, right? So from X to X plus N, time is increasing, then we need to treat it specially. So here, because it's uniform over 0 to 2, right? Same logic, bt, the benefit, bt is a special one, is t, right? Then multiplied by e minus 0.5 t and multiplied by 1/2. Why the 1/2 is f of t dt, right? So just to remind you, this is the bt benefit, it's t. This is like the interest, the vn, the interest, and this one is ft. Now this one is easy to integrate because it's a small term, but we still need to, well, let's take 1/2 outside, 0 to 2, t e minus 0.5 t t. There is a trick to evaluate this one, because you can recognize that this one is exponential distribution, so you can simply use the expected value of exponential distribution. But if you forgot, you can use integration by parts, and this is easy. I usually do it this way quickly. This integrate to 1, like derivative of this one, and the derivative of this one is 1 over 0.5 minus e minus 0.5t, and then I take, then this one will be t divided by 0.5 minus e minus 0.5t minus 1, because now we have 0.5, you take another one, 1 minus, this becomes positive here, 0.5 to 2 multiplied by e, and then minus 0.5 t, and this we need to evaluate the whole function from 0 to 2. And this is if you evaluate it from 0 to 2, I mean if you log in after a little bit of calculation, this will become to 0.9358, right? If you evaluate it, just to plug in your numbers, you should get this number, right? Just to double check, yeah, good. All right, so this is straightforward, this one. It's just you need to do integration by part. But you can, again, as I mentioned, recognize that this one here is uniform distribution with u is 5. So you take, what's the expected value of this one is 1 over 0.05. But because we don't have 0.5, then we need to divide by 0.5. So it gives you exactly the same answer if you do this way. Okay, so yeah, this is for the increasing function. Let's look at decreasing function now. Decreasing insurance. And we'll go with the continuous case as we said, payable at time of death. But because decreasing insurance, you know, there is a little problem here, because if you keep it unlimited, remember when for IA we have this option to be unlimited, right? But because it should be limited with the life, at one point it will end. Why? Because nobody has, you know, will live forever. So it will end because it's the function that the limit of the survival function when t approaches infinity will be 0. The problem here, if you keep decreasing, we have a problem mathematically that it will get into negative. So in decreasing insurance, only we have term insurance. Again, why we only have term insurance? To avoid the possibility of negative value, negative payment. So we would have like usually the case, let's take one example. Let's take the same example we did. X is uniform. Oh, let's say like remaining lifetime is uniform on 0.2. We have delta 0.5%. So we want to find dA, right, of X. It gives you 1. Sorry, let me just write it again. D decreasing, A insurance payable at time of death, right? For a life that is age X, we need to limit it now to, it has to be limited to 2, because if you don't limit it to 2, it will go in negative. And this is very easy, right? All you need to do is, if you visualize it here, 0, 1, 2. So if death occurs here, at moment of death, it's decreasing. It starts with n. It starts with 2. If death occurs here, it will give you 1. Right? It's decreasing. It starts with n and it decreases. So this one, how we evaluated, the same logic. We use exactly the same logic we did before. So how we evaluate this one? We start from 0 to 1 to the benefit, multiplied by E 0.05 the force of interest t, multiply by, because it's uniform, ft will be equal 1/2, so multiply by 1/2 dt, plus the same logic from 1 to 2. Now we have 1 e minus 0.5 t multiplied by 1/2 dt, cross cross. So we will have, now if you evaluate this one, it will be 1.4393, right? If you evaluate this one, it will be, this is the answer, right? But it's important to understand the logic, because we will look in the next session how we can play with this to with complex questions, right? So this is straightforward, not much here. In next session we will add also the discrete case. So we looked at the continuous case. In next session we'll look at discrete case.